Ladies and gentlemen, good day and welcome to the Atlanta Electricals Limited Q2 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chaitanya Satve from Adfactors PR. Thank you and over to you, sir.
Good morning, everyone, and thank you for joining us today to discuss the unaudited financial performance for the quarter and half-year ended 30th September 2025. I have with me Mr. Nirmal Kripesh Patel, Chairman and Managing Director, Mr. Akshay Kumar Vanchilal Mathur, Chief Executive Officer, Mr. Anand Sharma, Chief Operating Officer, and Mr. Mehul Suresh Mehta, the Chief Financial Officer. Before we proceed, I would like to bring to your attention that certain statements made during this discussion may constitute forward-looking statements. These statements are based on our current expectations, assumptions, and beliefs regarding future developments and are inherently subject to various risks, uncertainties, and factors beyond our control. Such forward-looking statements involve both known and unknown risks, and we advise you to interpret them with caution. I will now hand over to Mr. Nirmal Patel for his opening remarks. Thank you, and over to you, sir.
Thank you. Good morning, everyone. A very warm welcome to Atlanta Electricals Limited earnings conference call for quarter and half-yearly end 30th September 2025. Our results, investor presentation, and media releases have been shared with the stock exchanges and uploaded on our website. I trust you have gone through them. Before we move into the financial and operational updates, let me begin with a very quick industry outlook and the strategic content of how the industry overview is. The power equipment and transformer industry continue to be a strong structural growth trajectory for both India and globally. Domestically, the environment is highly encouraging. India's power transmission grid is undergoing a significant transformation led by NEP, the National Electricity Plan, and the Green Energy Corridor, and ongoing revamped distribution sector schemes, the RDSS schemes initiatives. These programs together aim and strengthen the grid reliability, expand interstate transmission capacity, and enable faster renewable energy integration. The government's continued emphasis on self-reliance in power equipment manufacturing under the Make in India initiative is driving clear visibility for domestic manufacturers. Additionally, the planned Rupee 9.6 trillion capex in the transmission projects through 2032 provides a multi-year demand visibility for power transformers, reactors, and allied transmission and distribution components. With a backdrop, renewable energy integration has emerged as the single largest growth driver. India's commitment to achieve 500 gigawatts of non-fossil capacity by 2030 means a large-scale evacuation infrastructure will be required, particularly in solar hubs like Rajasthan, Gujarat, and Karnataka. The transformer market is directly benefiting from this transition, as higher capacity units, meaning 220 kV and 765 kV class, are being deployed for solar cooling, hybrid renewable corridors, and interstate transmission lines. Globally as well, momentum is strong. Countries are accelerating grid modernization, digital monitoring, renewable connectivity investments. Additionally, the rise of data centers, green hydrogen, and industrial electrification is creating a new category of transformer demand. This gives Indian manufacturers, particularly those with high technical depth like Atlanta, a clear opportunity to expand export share over the medium term. As Atlanta, FY26 has been a pivotal year, one where we are consolidating scale, unlocking our new product capabilities, and positioning ourselves for the next phase of growth. Our total manufacturing capacity now stands at 63,000 MVA, making us one of the largest integrated transformer producers in the country. This expansion gives us ability to participate across high voltage range, from 66 kV distribution transformers and power transformers all the way up to 765 kV extra high voltage units. The recently acquired BTW facility is a key milestone in our journey. With its established engineering pedigree and the high voltage testing infrastructure, the plant significantly strengthens our capability to address 765 kV products. Once fully ramped up, the facility alone represents a revenue potential of about 600 to 700 crore annually at an optimum utilization. In parallel, our Vadodara facility has now become operational and we have begun contributing higher kV production from the second half of FY26 onwards. This unit will serve as a specialized hub for 400 kV class and 765 kV class products. We are at advanced stage of obtaining PGCIL and NABL approvals, which will allow us to participate in the next wave of large transmission and utility tenders. Our integration of Atlanta Trafo Private Limited, erstwhile BTW Atlanta Transformers India Private Limited, is now complete, allowing us to leverage shared design systems, vendor tools, and quality assurance frameworks across all facilities. Together, these assets form a cohesive manufacturing ecosystem which is built in flexibility to shift production, optimize cost, and deliver higher MVA orders within shorter time cycles. Looking ahead, our strategy remains clear and execution focused. Scale capacity utilization across Vadodara and BTW plants during H2 FY26 and FY27 also. Expand into higher kV class and MVA classes where entry barriers and margins are structurally higher. Broaden our export footprints, leveraging India's cost competitiveness and our proven technical standards. Deepen automation and digitization to sustain margins, quality as volumes rise. As we move into the second half of FY26, we expect both top line and profitability to strengthen meaningfully, supported by a favorable industry cycle, high utilization, and improving product mix. With all that, I now invite our CEO, Mr. Akshay Mathur sir, to take you through the detailed financial and operational performance for the year, for the quarter and the half year. Over to you, Mathur sir.
Quarter 2 FY26 marked another period of steady execution for Atlanta Electricals as we continue to strengthen operations, enhance efficiency, and maintain disciplined financial framework. Before I go into the numbers, I would like to highlight that in our industry, revenue recognition is linked to dispatch, factory acceptance test, which we call FACT, and site acceptance milestone, which typically cluster post-monsoon as utility schedules shutdown and year-end capital expenditure. As normally the second half of the year delivers a stronger performance both in revenue and profitability. Coming to financial highlights of Quarter 2, FY26. Revenue from operation for Q2 FY26 stood at 317 crores, up 17.3% year-on-year, while H1 FY26 revenue stood at 632 crores, up 10.9% year-on-year. This is driven by robust execution in the transformer and healthy order inflows from utilities and industrial clients. EBITDA for the quarter was rupees 55 crores, while H1 EBITDA stood at rupees 104 crores. EBITDA margins for the period Q2 FY26 and H1 FY26 stood at 17.3% and 16.4% respectively, mainly backed by operating leverage benefits, a favorable product mix, higher contribution from power transformers, and improved procurement efficiency of key raw materials like copper and CRGO steel. PAT grew by 8.7% in the H1 FY26 period, though it declined by 6% in Quarter 2 FY26, mainly due to higher depreciation and interest expenses arising from capacity expansion and working capital requirements to support the increased scale of operation. EPS for the quarter stood at rupees 3.6, while H1 EPS was rupees 8. Operational highlights. Operationally, our legacy plants continued to run at 100% utilization throughout this quarter. With the integration of Atlanta Traco Private Limited and new Varos plant now complete, our total capacity expanded to 63,060 MVA, enabling us to deliver higher kV and MVA transformers efficiently. Our order book as on 30th September 2025 stands at rupees 2,069 crores, providing strong execution visibility for the next several quarters. From a market perspective, demand visibility remains extremely strong. Our recent order will include in renewable, we are seeing significant order inflow from large cooling substations. In quarter 2, we secured orders totaling to nearly 789 crores, out of which orders worth rupees 463 crores are for supply of transformers for the renewable energy sector, where we already have a strong footprint. These transformers shall mainly be going to solar projects in Bikaner, Bijapur and Pugal, demonstrating solid traction from this segment. This order for rupees 463 crores for RE sector include a sizable order of rupees 56 crores for supply of 6 numbers 160 and 192 MVA 220/33-33 kV dual secondary transformer for solar cooling substation in Bikaner and Bijapur, and 40 crore order for 680 MVA 220/33 kV transformer for solar cooling substation at Pugal, Bikaner. On the export front, we have made a strong start. Our first sizable international order of rupees 20 crores for the supply of 132 kV class transformer, which aligns with our vision to diversify our geographical presence by the way of making an entry into global market, particularly in Asia and Middle East. Encouragingly, our inquiry pipeline for export continues to expand, and we see the potential for export to contribute meaningfully to revenue over the next 12 to 18 months. In transmission and grid modernization, utilities are prioritizing higher voltage corridors, and we are actively participating in tenders of 400 765 kV transformers from both state utilities and PGCIL-linked EPCs. Industrial and data center segments are also showing encouraging momentum, with India emerging as a major hub for hyperscale data centers. There is a growing demand for high-capacity, low-loss transformers with enhanced reliability features. We are currently engaged with several large private developers to supply transformers for upcoming data center parks in Western and Southern India. Overall, our order book stands at a healthy, well-diversified across PSUs, IPPs, EPCs, and private industrial clients, providing clear execution visibility into FY26 and FY27. At our Varos facility, we have a major milestone achieved. This unit is now an ISO certified manufacturing unit, underscoring our commitment to quality and process discipline while reinforcing customer confidence. Our NABL acquisition for the in-house 3 testing labs is in the final stage, with audits and documentation substantially complete. Once approved, this will allow us to conduct advanced in-house testing for high voltage transformers, reducing external dependence and improving turnaround times. Meanwhile, the PGCIL plant approval process is progressing well, with the customer audit scheduled for November 2025. We are fully prepared and confident of completing it successfully. Together, these milestones will enhance our eligibility for large EHV tenders, strengthen to compliance credibility, shorten lead times, and contribute to better cash conversion and operational efficiencies. Outlook. As we enter the second half of FY26, we expect a stronger traction in both domestic and export orders, improved cash conversion, and resilient margins. Our healthy order book, operational discipline, and continued focus on EHV and renewable linked projects will support sustained growth momentum. Thank you. Thank you very much.
Thank you, Manu sir. To summarize, Atlanta Electricals is defining its stage of growth journey. With expanded capacity, entry into 765 kV class and 400 kV class transformers, and growing traction in the renewable transmission and export markets, the company is well positioned to deliver substantial profitable growth. Our consistent execution, strengthened financial position, and continued investment in technology allows us to deepen our customer trust and create lasting value for our stakeholders. We look forward to a strong H2 FY26 and remain confident of maintaining our momentum through next phase of expansion. Thank you for joining us, and we now open the floor for questions.
Thank you very much, sir. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use headsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Sagar Dhawan from ValueQuest. Please go ahead.
Yeah, thanks for taking my question. My question is on the new CapEx that has been announced on the IDC transformer side. So what is the timeline for the completion of this CapEx?
This is Neeral Patel this side. I'm sorry I didn't get your name, sir.
Yeah, hi sir. This is Sagar Dhawan from ValueQuest.
Hi. The CapEx, historically we've created benchmarks to finish our CapEx on time. We intend to finish this CapEx also within a span of 9 months.
Okay. And sir, is this meant for domestic mainly or for exports?
This is for the inverter duty transformers, mainly for solar applications, solar power generation side, targeted for domestic market.
Understood. And on the capacity terms, if you could also tell us how much this quantifies in MVA terms, and what kind of top line it could generate at full capacity utilization?
Inverter duty transformers range from 6 MVA all the way till 15 or 16 MVAs in the market as per the customer's requirement. We intend to produce more of 12.5 and 13.5 MVAs from this facility. The intended facility is 5,000 MVA only. These are small rating transformers, so the MVA facility is less.
Okay.
I hope that answers it.
Sure. And just one more follow-up. In terms of the top line, which it could generate, if you could quantify that as well, at full capacity utilization, how much could this plant generate at what top line? Got it. Thanks for that. And just one last question from my side is your raw material sourcing bit. Could you also tell us about how do you source the raw material? Is it largely domestic or are you import dependent in terms of the sourcing across the components like winding, core, etc.?
So the sourcing of raw material is largely domestic. Of course, some of our vendors, when we talk about CRGO, may be relying more on the import cycle for the CRGO steel. However, majority of the material is sourced domestically. There are certain components that are specifically imported for higher kV class, like insulation material, RIP bushing, tap changers. We have long-standing relations with our suppliers, and we are, as of now today, getting deliveries on time. The trick of the game is to place orders on time and give them booking well in advance, and we end up getting material on time.
Understood. Thanks for the questions. Thank you.
Thank you.
Thank you, sir. Our next question comes from the line of Vignesh Iyer from Sequent Investment. Please go ahead.
Hello. Thank you for the opportunity. Wanted to understand this 2,000 crores plus order book that we have right now. Is there any order, as a part of this order book which needs to be executed only from the new facility? Or is it, executable in the old facility itself?
About 300 crores order book is 400 kV class, and that is supposed to be executed from the Vadod facility, which is now commissioned. Balance all orders would be under 220 kV class, and that can be executed in our newer facilities as well, and of course the older facilities.
Okay.
Like Mr. Mathur Saab explained, the older facilities are operating at full efficiency, so now the load is diverted to the newer facilities.
Right. So, if I get it right, the acquisition we did plus the new Vadod unit, both can execute lower kV as well, right? If I understand it right.
Yes.
Okay, got it. And my second question is, wanted to understand what is the timeline for executing this 2,000 crores order book?
Some certain orders may spill into the next financial year.
Okay.
So every transformer would have its respective delivery lines. So definitely certain orders will spill into the next financial year.
Any number, any ratio, if you can help me understand, or a timeline like a 12-15 months, what is the usual timeline for executing the order?
Typically 220 kV class orders last between 15 months to 24 months. 400 kV class lasts between 18 to say 2.5-3 years is what the contracts are for longer quantum from a large transmission company.
Okay. Got it, sir. Yeah, that's all from my side. Thank you.
Thank you, sir. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question comes from the line of Chavin Zaveri from Share India. Please go ahead.
Yes, sir. Thank you for the opportunity. So my question was with regards to solar panel manufacturers are now entering the transformer space, basically for their own capital consumption. So will there be any effect on our business?
The transformer manufacturing, there will be incremental capacities coming in. We are aware of that. And looking at the market size that we have to cater to, it is whatever capacity that we build is going to be smaller. And hence, the inverter duty transformer manufacturing facility was planned. The added advantage to this is we can actually provide for the total package for any solar independent power producer, wherein we can supply inverter duty transformers in volumes on fast track basis and at the same time take over the higher kV class products, namely 132, 220 or possibly 400, whichever is the requirement of the customer.
Okay. My next question is with respect to raw material, did the company face any supply side constraints this quarter? And if there is any, do you plan to get into backward integration and set up some bushing plants or the CPC plants for your own backward integration?
Good morning, sir. Anand Sharma this side. On the raw material front, as Niribhai was just saying, that we are pretty confident and equally backed up by our good suppliers. Having said this, we certainly have plans to do certain amount of backward integration for few of the items like radiators and tank to start with. Apart from that, other items would be a long shot, so providing a detail of it would not be fair at this point in time. The details of radiator plant and tank plant is something which we are trying to crystallize upon and shall announce our plans in a short duration from now.
Okay. And do we plan to get more into the export side of the business, or mostly the business will remain domestic for going forward?
Sir, we shall keep a healthy mix of domestic and export. Our priority certainly is going to feed the domestic customers for supporting this Make in India initiative led by the Government of India. But certainly, the export market certainly provides better opportunities for the margins and our geographical diversification. So we shall keep a mix of at the most 15% going to the export market out of our total revenue, and balance 35% approximately shall still be kept for the domestic market.
Okay. Thank you so much.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question comes from the line of Charchit Maloo from Genuity Capital. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. So my question is, our PAT grew by 8.7 in H1 FY26, so it declined by 6% in Q2, mainly due to depreciation and interest expenses. So, sir, my question is, when will our scale will increase to a level that operating leverage will, come below EBITDA level to play along?
The outputs from the newer manufacturing facilities will be seen in H2 of this year itself. We will be witnessing that change coming in the Q3 itself, since the plants are operational. The EBITDA levels are the drop that you see. Yes, I agree, it's mainly for the interest cost, and the interest cost has been paid off by the money that we have raised from the equity markets. Apart from that, the loss is also for getting the newer facilities operational. And now, since they're operational, the revenues will definitely, back up the revenues generated, and the profits from that will already take care of the added costs that is coming in.
We are saying from Q3 onwards, operating leverage will kick in?
Yes, yes.
Got it.
I would like to clarify that on the orders which we are booking, we are not seeing any kind of decline on the margins. So it's only for the temporary or one-time cost which we are incurring for amalgamating the plants, newer facilities or this thing, and the startup cost for the newer plant, which is making some dent on the margins at the moment, which is showing up in the Q2 results.
Got it, sir. Got it. So, my next question is regarding the new capex of 65 crore for our inverter duty transformers. So I just wanted to check how depreciation and interest costs will play out as we ramp up the capex, but it will take time for the capacity utilization to kick in.
Sir, it is a significantly small-sized capex. It's a significantly small-sized plant. The plant is only to enable us to deliver quantums to a customer when it is required. The inverter duty transformers are smaller transformers. However, they are ordered in bulk. And unless they are commissioned, the customer cannot commission a solar power generating facility. So it's a significantly small-sized capex. We possibly would be going out for a term loan for this, but not to a significant size. Close to about 50 crores will be the term loan, and that would not impact the margin significantly.
Okay. I also would like to add that this certainly matches with the philosophy of the company, which we have been following till date. So for each voltage class or each type of product, we have one plant. For these inverter duty transformers, which we are manufacturing as of now in our unit 2, which is meant for the production of 66 and 132 kV class. When we move out this particular production to a newer facility, which is meant for only inverter duty transformers, we shall be freeing up the space at our unit 2, and we shall be able to produce more of 166 and 232 kV class transformers. At the same time, we shall be able to put better focus and the productionization of 33 kV inverter duty transformers also. So on both sides, we shall be benefiting with this inclusion and the addition of this new plant which we have recently announced.
So like there will be no impact on the margins, like because since it is very small capex, right?
Yes, there will be negligible impact on the margins since it's a very relatively small capex for a company like Atlanta.
Got it. Like just last question, can you just give me the H1, H2 revenue ratio and like what will be the margin profile of high voltage transformers as we are idle?
H1, H2 revenue ratio, I fail to understand.
Like contribution from H1 versus H2 revenue.
Q1
we would not be able to give any forward-looking guidance on the current H2, how it's going to perform, very frankly speaking. But at the same time, H2s are usually larger because that's where the customers would like to commission their facilities and capitalize them. Q4 is significantly, the volumes insignificantly are more in the quarter 4. But like I mentioned in my last earnings call, we have grown leaps and bounds. Last year's growth rate was close to about 40%. We intend to keep the same growth trajectory in this year itself and significantly confident in terms of the order books that we have and significantly confident in terms of the newer capacities that are getting added which are mammoth sized.
Got it, sir. And like what are the like margin profiles for high voltage transformers?
A couple of basis points higher is what we anticipate for a near future. Because entering into these segments is something where, it takes a lot of technology cost, research and development cost. Once stabilized, the margins turn out to be better. We achieve economies of scale and the margins turn out to be better.
If possible, can you just quantify if possible?
It will be difficult for us to quantify since the first product gets manufactured and that would be the right time to share the information. Right now, all I'll be sharing is basic estimates and which we would not like. But yes, we know that they are higher. We know that they are better. But it's only after manufacturing the first prototype we would be able to comment upon it.
Got it, sir. Thanks a lot and all the best.
Thank you, sir.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question comes from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Thanks for the opportunity and congrats for a good set of results, sir. Just 2 questions from my side. Wanted to check on how do you see, let's say by 2030, if you want to look at the company, what would be the product mix and what would be the sector mix? Right now it's 75-25 on product side for power transformers across the other transformers and T&D being a major share. So by 2030, given your capex plans and you're getting approval from other bigger vendors and moving into high voltage, how would the mix look like?
The ideal mix for the company and would be our focus. It would be to fill the facilities with their respective kV class transformers and to make sure that would generate the optimum utilization and that would generate the best possible revenue from the facilities. Going forward, the newer facilities that we've created, I'm assuming larger transformers would be procured by Power Grid Corporation of India, NTPC, and larger IPPs who would require these kind of transformers. By FY30, we see ourselves as a very dominant player of 400 kV class. We see a very dominant player of 765 kV class also by FY30 because the company is working on research and development and tech types for both kV class as we speak.
Understood, sir.
The market, when you talk about 70-30, we intend to keep more or less the same ratio because these transformers, when they are actually purchased in larger volumes by state transmission companies and central transmission companies, and this ratio would possibly remain the same.
Understood, sir. Secondly, sir, most of your competitors like you have also expanded the capacity. So where are we in the stage in terms of market? Are we closer to, demand matching supply, or is still a gap, a bigger one?
So the gap is there as we speak, and the gap is going to be there, say 3 years down the line also. Regarding the requirement our country itself has, the gap is going to be huge. And that's where, the central power transmission companies are encouraging more and more people like us to set up, or expand their manufacturing base. The targets, the country sets, our nation sets, are targets for long term. And when the targets are achieved, that doesn't mean that the new target will not come. So as and when the target is achieved, the new target will come, and the new targets will further require transformers.
Understood, sir. And we have seen the prices on the raw material side have started inching up. What is the strategy for company to ensure that we'll continue to maintain, healthy margins? And do we hedge any commodity, etc.? Any policy would be great.
So, we, as you know, and we have been telling that we are keeping a healthy mix of orders between the utilities and the private players. So, at the moment, 70-30 is the ratio which we have been following, and we are following now also between the utility and the private players. Utility orders comes with the price variation formula, which provides us a natural hedging against any variation in the raw material prices. For rest of the 30% orders which comes from the private players, EPC, IPPs, etc., we certainly have raw material price hedging practices in our organization, which certainly will be able to protect us from any kind of a spike or a depression in the raw material prices.
So to add to it, if you see our numbers on standalone basis, there would be a significant correction, meaning the cost of goods sold have gone down. The prices of the material may have gone up, but their relatively pass-through mechanism is present, and that's the reason the cost of goods sold have gone down. When we say this, we know because of the order book that we have, a 220 kV order book typically gives you an 18-month visibility, and below, 220 kV and below would give you an 18-month visibility. So the order book that we have, we don't see any price pressures or cost escalations coming in.
But the CRGO steel, what we understand, steel is not hedged. So how do you protect yourself when you have exposure to those things?
So CRGO is not hedged by any steel manufacturer. But what you can do is that you can, whenever you are booking a private order, which is not backed up by a price variation formula, equivalent amount of CRGO coils, you can place the contract with. You can finalize the contract directly with the mills. And that will certainly provide you the hedging on the CRGO side. So there are different ways and means to hedge the cost or the price of different items. For copper, it's one, CRGO is another. For oil, it would be different. So yeah, there are different ways and means of doing it. And we are adopting the best possible methods to hedge the price wherever it is needed.
Understood, sir. And lastly, sir, there has been some news reports which are ongoing that there is a threat of Chinese competition coming in on the power equipment side, including transformers. Have you seen any, rise of Chinese players or via Indian company route in the low voltage or the medium voltage category?
We particularly have not come across any such data. So whatever you are saying, we will have to verify it at our end, and then only we'll be able to provide you any answer for that. In particular, for the high voltage ratings where we are present, we have not witnessed any such kind of supplies coming in from China.
Fair enough, sir. Thanks for answering all the questions and wishing you all the best.
Thank you. Thank you, sir. Thank you. A request to the moderator if we can have one question per person so that everybody gets an opportunity.
Sure, sir. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit the question to one question per participant. Should you have a follow-up question, please rejoin the queue. Our next question comes from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Hello. Sir, I wanted to understand, one of our competitors recently acknowledged that there is a short supply of CTC and bushings. How are we placed in that matter when it comes to procuring this?
Sir, as we have been telling earlier also, and we have answered a few questions earlier to your query on this call also. We are a company which is backed up by its supplier pretty well. And as Neeraj sir just mentioned some time ago on this call, that the trick of the game is to place the orders well in time. If you are able to provide a good amount of visibility to your suppliers, there is no way they can fail you. And that is the strategy we have been following by providing future information of the orders to our suppliers. And as such, we have not faced any such issue, let it be on the CTC or the CRGO side. We are pretty secured on that, on all fronts, including these two fronts.
Got it, sir. Just one last question from my side. On the finance cost part, our debt is around 350 crores. This quarter we have had a finance cost of around 13 crores. So what would be a steady state finance cost going ahead for the next 2 quarters?
Mehul, have you answered the question?
Yes, sir. Good morning. Mehul this side. Sir, finance cost, as you mentioned, includes long-term debt of 350 crores, which was taken for Vadodara project as well as BTW acquisition. However, from the proceeds of IPO, we have repaid the 130 crores of debt, which was taken for Vadodara facility. So, and another 85 crores, which was taken for the acquisition of BTW facility. Now, long-term debt in our book stood at 125 crores as on date. This means that finance cost will be significantly lower in the H2 numbers. However, finance cost will be there because of the additional working capital which will require to pump up these two plants.
Okay, what is the cost of borrowing on the working capital and term loan?
So there are different costs. So working capital front, we envisage around interest rate of 8.5 to 9%, whereas for term loan it is around 10%, 10.5%.
Okay, sir. That's all from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question comes from the line of Janam from Saitoro Investment. Please go ahead.
Hi. Congratulations on a good set of numbers. I wanted to understand how strong the order pipeline is. While I understand that the order book is healthy at around 2,070 crores, if you could provide some texture and color and quantify what sort of bidding are we doing and what is the typical win rate, that would be helpful.
Sir, our strike rates are close to about 20%. The order inflows are pretty healthy. Last quarter order inflow was close to about 300 crores. This year's order inflow is approximately 700 crores is the order inflow. So the order inflow is pretty healthy. When we talk about numbers, yes, when these numbers will look much better in years to come, because then we would be having 400 kV class order books like we mentioned, and those order books, the numbers will be significantly more. That doesn't technically mean that we have to make so many units, because each unit value would be more. we are focused on, getting orders on all KV classes so that all facilities remain operational. I hope I've answered your question.
So, I mean, if you could quantify, is it like 10,000 crores worth of bidding that we are doing? Crores to just get a perspective as to what's going on. Because while we understand the demand is unprecedented, but to get some idea and some color, that would be very helpful.
I've noted this question, Jainam sir. So what I'll do is I'll revert back through the moderator. We don't have the exact number. It will be not right to give the exact number, but I'll revert back with the moderator. It will be close to anywhere between 12,000 to 18,000 crores. But the exact number, I would come back to you on that.
That is very helpful. I'll get back in the queue. Thank you so much.
Sure.
Thank you, sir. Our next question comes from the line of Hardik Gandhi from HPMG. Please go ahead.
Hello, sir. Am I audible?
Yes, sir, you are.
Yeah. Thank you for the opportunity. And just wanted to know two things. First is that we saw that TRIL got blacklisted on by World Bank. I don't know if this question has been asked. Apologies, I joined late. But are we expecting any flow through because of the bad market reputation of TRIL?
I'm sorry, sir. I don't understand the question.
So our competitor, TRIL Transformer Rectifier, they recently got blacklisted by World Bank on the international market on the basis of corruption. So I don't know if you've seen the market also. So given that such thing is going on, are we expecting any additional orders, to come through to us? Have you looked at that by any chance?
Sir, I am aware of this situation, but however, I will not be able to comment anything on it. Regarding the exports, yes, we are looking at exports pipeline to build an export pipeline. Our strategies are a little different when we speak, but we don't see any of such advantages that will be coming in near future.
Understood. Second thing is that I saw that although we did mention about the debt repayment and everything in the books, we were still holding on to the unutilized amount for debt repayment as of September. And in the cash flow, we had increased our long-term borrowings. So I just don't know why we would sit on cash rather than repay it at that point in time. Wouldn't early repayment help us save interest cost?
It would, definitely, sir. September 29th or possibly the 30th is when we closed our initial fundraising, and hence the numbers look like this. Of course, the first week of the first week of Q3 is when the decisions were taken and the money moved out.
Understood. And the last question, if I can just add, for the CRGO prices, just for a person, for a layman, how is someone able to track it? Is there an international index for the same, or how can one track it, if you can guide us on that?
So incidentally, there is no index for CRGO prices like we have for copper or maybe for oil. CRGO prices can only be tracked by the continuous interaction of yours with various mills sitting across the globe. That is how you get the flavor of what is going around in the world and take your decisions accordingly for now and for future.
Understood. Yeah, that's it from my end. All the best. Thank you.
Yeah.
Thank you. Our next question comes from the line of Utkarsh Somaiya from Aigo Quantum Solution Private Limited. Please go ahead.
Thank you for the opportunity. I just wanted to confirm that at peak utilization of 60,000 MVA, our top line will be close to 3,500 crores, correct?
That's the number that we had given in the last earnings call. Yes, that's anywhere between 35 to 3,600 crores.
And by when do we expect to reach peak utilization?
We project that to be happening in FY28.
And when we do, two-thirds of our capacity will be from 400 and 765 kV class transformers. Am I right?
I'm sorry, sir, if you can repeat that last line.
Sorry. When we operate at peak in 2028, two-thirds of our capacities will be from 400 and 765 kV class transformers. Am I right?
Yes. Yes.
And right now we have all our revenue comes from 200 or below kV class, and we are doing 15% EBITDA margin. So when we operate at peak utilization, what kind of EBITDA margins can we target?
Sir, it will be difficult for us to comment on it. Like I said, the 400 and 765 kV class have better margins. The company per se, when we breach the entry barriers and we do our research and development, the couple of first years would have a little R&D cost over it. So it will be a couple of notches in the first couple of years, and then eventually by FY28 onwards, the margins will be significantly higher when we stabilize with the product in the market. So to give you an exact estimate would be a little difficult because we have yet not manufactured the first prototype.
So I don't want to exactly know what the company will do, but I just want to understand for anybody who was making a 200 kV class transformer versus somebody making a 400 or a 765. I just want to understand the difference in profitability as an economics, the economics of the two products. If you can give some color on it.
So like I said, I would be 100%. I would love to give you that color on the product, on the kV class. However, with a little bit of relevant experience, the number that I say would be correct. Without experience, to say anything would not be correct on this call.
Okay, no worries. Thank you, and best of luck.
Thank you, sir. Thank you.
Thank you. Our next question comes from the line of Jainam from Celtero Investment. Please go ahead.
I had a couple of questions. I'm looking at your presentation. In Q1, the order book for 30th June is 1584 crores, but if I'm looking at slide number 9, for Q1 it shows 1643 crores. So both the slides again for June quarter is showing 1171 crores in Q1 FY25, and here in Q2 it's showing 1171 crores for the next quarter, which is Q2 FY25. So could you just help me understand what is the order book for which particular quarter it was? I mean, I'm a little confused.
Yeah. So, sir, order book for, as you are looking at our presentation, order of 1171 was for 30th September 24.
Yeah.
Right? Then on 30th June, it was 1643 crores. As of 30th September 25, it is 2069 crores. During March, as of 31st March 25, it was 1600 crores. So this was
so if you look at the Q1 presentation, slide number 8, for 30th June 2024, it shows 1171 crores. So what was it for the June quarter, Q1 FY25? Because I think you were saying it's for Q2, right? 1171 crores. Q2 FY25 was 1171 crores.
Yes, sir. This is correct. Q2 of FY25 was 1171 crores.
So what was it for Q1 FY25? Because in your first quarter PPT, for June quarter, it's stated as 1171 crores.
No, sir. So the presentation which we published yesterday, that is 30th June 25, order book was 1,643 crores. That is correct.
Okay. I'll probably get back to you later because I also want to get an idea for Q1 FY25, what is the order book. I'm still not very clear. So maybe that as well as the order pipeline, I'll just get back to you a little later on the same. And one last question I wanted to understand the BNC power order that we want for 400 kV class. Can we see execution of that happening in this year, given that we had it in the first half of the year?
No, sir. The execution will not happen this year. However, we would be starting to manufacture those products this year. Those products are due for delivery in the next year. 400 kV class, usually the lead times are anywhere between 15 months to 18 months. That's where the EPC contractor or the customer, or whichever type of the customer, would have time to develop the relevant infrastructure for the transformer to reach there.
So we see the execution to happen to get completed in FY26. Is that correct?
Yes, absolutely. Q1, Q2, all Q quarters of FY26, we would be only focusing on 220 kV and below.
Perfect. Thank you so much. Thank you.
Thank you. Ladies and gentlemen, due to the time constraint, that was the last question for today. I would like to hand the conference over to the management for the closing comments. Thank you, and over to you, sir.
Thank you, everyone.
Thank you so much. Thank you, sir. Ladies and gentlemen, on behalf of Atlanta Electricals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.